the traffic was beyond expectationally bad. Okay.
You just let me know, Rania, when you want me to.
I'm good.
Or remember these, or you got to be pretty close to those.
Okay, got it.
Ready?
Mm-hmm.
All right. Welcome in, Joe Kuchera with Real Estate Radio Live. Thank you again for watching the show and following us on Facebook as we continue the live feed here. Before we get started and get into our conversation today with Jack Russo, as we try to do every week, going to be part 6. Just a reminder, a couple different things. You could get more information by going to reradiolive.com and download the podcast. That's the best thing to do. That way you can follow the show, listen to us at your convenience at any time. Again, it's reradiolive.com. For those that like to go out and hang out in iTunes, you could just type in Real Estate Radio Live in iTunes. You can come up and download the podcast there as well. All right, let me welcome back in Jack Russo. Jack, good to have you back.
Thanks, Joe. I discovered today, and your listeners, I was going to say readers, but readers and listeners who have Teslas, either the Tesla S or X or 3, you can search on their TuneIn.
Oh, you can?
For your name or your
right on the Tesla screen,
and then you bring down the podcast. So I was listening to
look at that.
Your podcast for Mr. Rossi.
Yeah.
And I was listening to that as I drove from Palo Alto, which unfortunately took longer than expected, but that's the way congestion is.
Silicon Valley.
And I thought to myself, it's kind of an interesting segue from his particular podcast discussion with you about real estate problems and litigation and controversy, because everything that we're going to talk about today in terms of documenting the initial financing is to avoid litigation or arbitration or even mediation. You don't want to have to do any of those things.
Yeah.
Those are just added transaction costs. You want to avoid that from happening.
Absolutely. No, that's a perfect segue. Well, before we jump in and get started, why don't you, if you could remind our listeners and our viewers and those that are listening to the podcast later, quickly your firm, a little bit about your firm and the areas of expertise in which you guys practice.
Okay, so I've been in Silicon Valley for over 35 years. It's soon going to be 40. My wife reminds me of that. And I've learned a lot along the way about what works and what doesn't work with respect to litigation avoidance, litigating wisely if you have to, dispute resolution, as well as how to do a startup to stay out of litigation and to start up a company wisely. And I would say that our practice at Computer Law Group, as well as the associated practice at Entrepreneur Law Group, and you can go to computerlaw.com or you can go to entrepreneurlaw-group.com and you'll find all the details about it, is essentially trying to guide people to do smart decision making. And oftentimes it does have a real estate twist, because we see a lot of founders who walk in saying, I probably can self-fund this. I'd have to take a second trustee on my house, but my wife is against it. Can I bring her in and we can talk about the pros and cons? I said, no, that's called marriage counseling. That's a different department. We don't do that.
A different type of intellectual property, right?
It sure is. And I'll tell you, a lot of the decisions, and the previous podcast that I just finished listening to as I drove here, about how buying or selling a house is very emotional is absolutely true. And borrowing money against a property, particularly for something that is a new venture, is also very emotional, because people, they want to believe in their idea, but there's always this, should we use our own money? Should we use other people's money? And of course, other people want to know that you're really committed. So they like it if you're using your own money. They like when you're fully in the deal. They don't like if you're straddling. So there's a lot of pros and cons to each approach.
Yeah, no, it's well said. All right, let's dive in a little bit and talk about. So this is part 6 as we'll continue this series, starting something in Silicon Valley. We'll continue to do this, and we're going to be talking about some more exciting things next week and some weeks to come as well. So, how would you categorize the very beginning of you're having a conversation with an entrepreneur that a startup? Now you're at the point where maybe they have some money in, they're about ready to bring in investors. So, how does that conversation start?
So the conversation usually goes something like this: look, I'm starting something. I think it's a brilliant idea. I've done some testing. I've done some experimentation. I've done a lot of research. I've done a competitive analysis. I've got a slide deck. I've done some domain name reservations. I've done a lot of stuff. I'm ready to get the business started. And I know that I'm going to need at least $50,000 to refine the pitch, and we can talk about how you go about refining the pitch, but refining where is the market segment, who is going to be the buyer, what dogs or class of dogs are going to eat this particular flavor of dog food.
Right.
I've used that analogy
Yeah.
before, but I think it's accurate. And I need to do some testing and evaluation, and it's going to require some third parties, and I can't get them to all do it on stock options or do it using other currencies. So I'm thinking about, and then fill in the blanks, $50,000 on credit cards, $50,000 second trustee of the house, $50,000 my parents will take a second trust deed on their house and loan me the money. But we want to document this if we do it. We want it to be at arm's length. We want it to be a fair interest rate. Or $50,000 from some other friends and family who are really, really very wealthy. And, frankly, they don't mind losing the money.
Yeah.
Of course, you have to believe that. The latest one that I had recently was, well, actually, those friends and family will probably advance to me more like $3 million. And, I do want to document it because I do think it's going to be a good deal for them. But they need to understand that it's still risky business and that may fail. So what's the simplest form of documentation? It's not just a handshake. Start there. Yeah. It's not just an email. It's not just a handwritten IOU, although I've seen that on the back of a napkin. And theoretically, if signed and if authentic, it will work. There may be a lot of gaps that have to be filled in by the law, but theoretically, some folks do very simple agreements. I've seen them handwritten. And then they come in saying, I did this agreement, but we never really answered how long the loan would be for, what the interest rate would be, what's the law going to do with that? Well, that's not what you want to have happen, because that's like a nightmare if it goes to litigation.
Well, we could get rid of that myth right away. I mean, I don't care. I know people still talk about whatever happened to good old handshake, but that goes out the window when it comes to something like this.
Even with parents.
Best intentions, right? Forget it.
I have to tell you, even with parents, I mean, knock on wood, it's not happened to me yet, Mom. No, seriously, even with parents, particularly if there are siblings, particularly if there may be grandkids and others, where it's like, well, you took a bunch of money and now Susie and her kids, my grandkids, need some money and you need to pay that back. And I thought you were going to do it a lot faster. You're much better off writing, even if it's a one-pager. And, of course, there are a lot of forms. And when I say to people who can't afford a lawyer, the Internet has really demystified a lot of this stuff. So you can go on places like Nolo Press, NOLOPRESS.com. Obviously, the LegalZooms of the world and lots of other places that will sell you forms. There are lots of free forms. There's lots of subscription sites. A lot of that stuff tends to be relatively simple and often junk, but I would say oftentimes junk is worth more than total junk.
Yeah,
right?
I mean, junk is worth better than nothing, right? Or a handshake.
I mean, for people who can't afford it, you're better off driving a car that still runs, even though it may be, a junker, than hitchhiking. Right. But a handshake is a little bit like hitchhiking. You probably if you do it too often, it's probably going to result in some disaster, right?
Yeah, so we have the agreement, so you come to terms, you have an idea, you're thinking about raising money, you have mom, dad, you have your own money, you have equity, maybe against some liens. So then you start talking about what type of documents, right? What type of documents are the best to kind of secure in this nature?
Right. So now here's the first rule of thumb. If you can avoid signing personally, you sign that loan on behalf of the LLC or the corporation. Now, you might say, well, wait a minute, Jack. You just finished saying that you're going to get the money from mom or dad or grandpa or grandma or family or friends. I'm not going to feel good saying to them, well, the entity that took the loan was actually a limited liability company that failed, so it can't pay you back. Well, that's the reality of how business works. Now, you might say, okay, well, maybe I'll make a personal guarantee. But most lawyers will tell you most of the time avoiding personal guarantees is the very thing you must do to protect your personal wealth. Now, if you want to personally guarantee, because, hey, mom and dad should get their money back, you can do that. But in the first instance, you want that entity, which hopefully is going to take some money in eventually, to pay that interest rate because it's a loan to the business. So people have a hard time with this. This water bottle is the entity. It has a certain amount of capital in it. It has a certain ability to continue to have water refilled into it. And of course, as you drink the water will go away. What's in my pocket is my personal wallet. It's not part of that limited liability company or that corporation. My wallet, people laugh when I pull it out because it's so thick, proving I'm not a millennial. Well, my wallet is really a separate and totally distinct, separate entity. That's called personal wealth. Now, you might decide to spend or give away all your personal wealth and your wallet's a lot thinner. That's fine. But your entity is your entity, and your entity is now doing a transaction. Even with mom or dad, you should document it with a piece of paper. In the simplest version, it would be a loan agreement. In the more complicated version, it would be a convertible loan agreement, which means it can convert into equity at a certain place. Now, the world has simplified some of this because now there's a new form of agreement that's called a SAFE, sometimes also called a SAFE agreement, which means simple agreement for future equity. Now, what was that innovation? A lawyer working for Y Combinator, one of the incubators that's out there, and there are now dozens of them, maybe hundreds of them, maybe thousands worldwide, said, even the loan paperwork scares people. They're not really looking to loan money to this little bottle of water, this little entity. They really are looking to the future equity. So why don't we just write that? Why don't we just say effectively that money is coming in as essentially a prepayment for what is believed to be a new round of financing. So the SAFE agreement, which a lot of people don't fully understand yet because, knock on wood, there haven't been many or any, to my knowledge, reported cases, and some of your viewers can correct me on this, but to date, at least in my look through the California cases, we haven't yet seen a reported case that said someone committed some tortious misrepresentation with that SAFE agreement. See, the SAFE agreement is actually a whole new category. It's, look, you're not really loaning money, you're advancing a deposit towards an equity purchase. And by the way, if that bottle gets emptied out and the company folds, there's really no equity that can be issued to you that's worth anything. So it's like a write-off from a loan point of view. But the difference, and this is the part that often people who sign these SAFE agreements don't fully appreciate, at least in my view, and someone will correct me on this, is if you had a loan agreement, you would be entitled to take a co-ownership of the assets that are left over if you have some IP rights left over. If you have a SAFE agreement, it's almost like the founders can walk away with those assets and say, well, we never got to the point of actually getting equity issued, so your deposit evaporated. Now, my view, and this is really an advanced part of the discussion, is down the road a court will likely say, look, if the impression that was given to that particular lender or that particular investor was they were getting some sort of protection by the assets that were accruing in that vessel, they're going to be treated like a lender. They're not going to be treated like, oh, well, you had a future opportunity to buy into equity that never happened. You effectively paid for an option to maybe get that. Well, that's a pretty expensive option if you then think about it.
Sure is.
So that's why there's this sort of uncertainty about SAFE agreements. But by and large, millennials and lots of other founders are using SAFE agreements because they're simple, they're easy to read, they're easy to understand, And most people probably do think, look, if the venture fails, everyone's going to walk away, and there's probably nothing left to fight about. What are the domain names worth? What are the jingles worth? What are the trademarks worth? Maybe there is even a patent application pending, but who wants to put more money into that? That becomes kind of the back and forth on it. And so this stuff gets simplified over time, but it also can become more sophisticated, because you could have a safe agreement that also has a side addendum that says, well, if there are assets, we would like those assets to first go to the safe investors before the founder gets any of it, as a way to say to the founder, we want you to be saddled with making the business a success. We don't want to see the possible opportunistic conduct that could happen after you raise $1 million with safe agreements, and then you walk away and say, well, sorry, that venture didn't work.
How long have these safe agreements been being used, roughly?
So I want to say Y Combinator innovated this about 4 or 5 years ago, but they were not instantly adopted. They became, as Y Combinator, which I think has been around now for more than 4 or 5 years.
More acceptable recently?
Yeah, what happened is people started to see that Y Combinator was picking some good horses. They were smelling some good dog food. They were choosing some good founding teams. And so some of those deals got hot. And so Y Combinator wisely said, look, we're not going to spend a lot of money on legal here. We like legal, and they're good people, and we like lawyers, but we've got these forms, and we can drill them through DocuSign and EchoSign and other e-signature programs, and we can get deals done very quickly this way. So they started pushing, and so you saw more of the legal community say, well, if it's good enough for them, well, why don't people use them? Because it's certainly a much more simplistic way. Now, we don't know what all the fallout would be, because, of course, unfortunately, 85% or more of these ventures fail. I mean, if you're doing 25% that succeed, I think you're way, way ahead of most other people's metrics.
Yeah, that's really good.
So that means some percentage are going to probably hit the fan of, well, what happened here? And what happened to the assets? And what did my safe agreement buy? Why don't I get a share of whatever the residual intellectual property might be worth? We're going to see that probably play out over the next 5 years or more.
Okay. All right, here's what we're going to do. We're going to take a quick break. We're going to come back today. It is part 6 with Jack Russo, talking about starting something in Silicon Valley. We're talking about the agreements, what type of agreements to use in these ventures. And when we come back, we're going to talk more specifically about those, how to raise money, who do you get it from, and then actually maybe a little bit about some valuations.
Yeah, okay.
How do you come up with those? All right, stay with us.
It's a black art.
Yeah, it is. Those on Facebook, stay with us. We're going to take a minute break or so, and we'll be back with you in just a minute or so. Hey, Rania, let me know when we start up the second. Give me maybe a 2 when we get to about 15 minutes or close to 15 minutes, or 1, just to let me know.
You got to get the clock organized, huh?
I know. I got to get what I did to get the clock.
You get
right
the
up
world
there.
clock.
I need the big clock right up there.
Yeah, the big clock up there would be good.
Either that or something right here blinking, right?
Or you can get the 65-inch display behind you, right?
Yeah, we're thinking about that.
That'd be the future, and then you could have a little pencil pad for drawing things onto that display.
Did you? We don't have the bundle select on Jack's round of pictures, do we? We got
some new logo.
Our new bundle images up here.
Oh, great.
Yeah.
Well, let's see.
Started using
can't
them
do
yesterday.
it now, right?
Yeah, it's in a different package.
Okay.
I'm going to wait till Monday because they're making all the final changes to the website right now. So all the legal stuff done, signed off.
So you could have 4 displays behind you. I've seen that too. You could have like the stock market going on in the background. I mean, it's like Trump.
They're Kardashians.
CNN going to the other one. That's pretty funny, right?
Yeah.
Yeah, you could have some reality TV shows, Shark Tank running.
So I don't know if well, I'll talk to you when I'm done.
Okay.
We'll get started.
Right.
That's a nice look. The lighting looks good in that from here, and I got bad eyes in that little camera there.
Yeah, you got a good
that light
camera.
really makes a difference, doesn't it?
Right.
Yeah.
Is that a makeup light or what is that? That's part of the. Yeah. No,
This is
sun
Ronia's.
lamp.
It looks good, though. All this stuff and everything, when you view it, it actually does. Looks good.
Someone said to me, Jack, you have a lot of gray hair. So I said, I better get a really shaved head. And someone on Facebook said, what happened to all your hair? And I was like, what do they comment? It's all gray. It's like, well, not anymore.
All right, welcome back in. Joe Kuchera with Real Estate Radio Live. We're continuing the series here. This is part 6 with Jack Russo and starting something in Silicon Valley. Jack is the managing partner at the Computer Law Group in Palo Alto, and we're going to be doing this continued series on a number of different things. There's a huge interest and really just in the Silicon Valley of startups. Where do you get started? There's so many people with good ideas. Where do you vet those out? Who do you trust? How much does it cost? I mean, we go on, and that's the reason for the series. We'll continue doing it. Before we jump back in, again, Jack, anybody that wants to reach you, more information about you or your firm, if they could help you, what's the best place to do that?
So the phone number is 650-327-9800. The website's computerlaw.com, and the email address is J-A-C-K, @computerlaw.com. That's computerlaw.com.
Very good. Let's get back and talk a little bit about safe agreements. You discussed those a little bit, Jack. There's some of the new forms, documents that are being used. We talked about kind of how people get started, getting money from parents, friends, family, equity from their home, basically just what they call the whole bootstrapping part, right?
The bootstrapping
and that would typically be, what would you refer that? Like there's all these levels, right? Friends and family money. What would you call the early?
The earliest form is really the bootstrapping. And the bootstrapping tends to be people who trust you.
Yeah.
So that usually is your parents, and usually your brothers and sisters, sometimes your in-laws, sometimes colleagues and friends, coworkers. I've seen all the above. There are ways, although you have to be careful, to literally go out, and I've seen this at my swim club, group of people that are pretty sophisticated. Mm-hmm. They'll just get together for like a card game. And of course, at the card game, someone's pitching a slide deck that says, and it might have been viewed years ago as bad form, but it's like that episode in Silicon Valley where the dentist or one of the doctors or something is supposed to be taking care of the patient, and the dentist pulls out a slide deck and says, "I got this new startup that's going to really innovate in this area," and it becomes infectious. So those people could, if they're appropriately qualified, and again, we've talked about making sure these people, these outside people outside your immediate circle, are accredited investors. That means they can actually sustain the loss. Now, theoretically, your parents are supposed to be accredited investors too, but the reality is the law accepts that families can work out without going to litigation, of course.
So there's kind of a provision there is what you're saying, in terms of family.
Families are viewed as, look, they move money around, they gift money, they loan money, they handshake money. I mean, the courts obviously don't like getting these cases. They're almost like divorce cases when a family member is suing another family member, not in the divorce context, but rather in the context of, hey, he took a bunch of money, he sold me this interest in this LLC, nothing ever happened. What gives? I want my money back. And of course, now we're going to delve a little deeper. There's sources of money that people don't even realize exist among yourself and your family, friends, and other colleagues who might not have immediate money they can go to their wallet with. What are those? People are doing self-managed IRAs, self-managed 401ks. Now, this is a bit of a danger zone because, of course, you're doing a deal for a very speculative venture, not unlike what people are doing out of their IRAs today, their Roth IRAs, their SEP IRAs, their 401ks, where they're putting money into cryptocurrencies. I know you had a session on that. I actually listened to that too. And I thought, people need to understand that these are highly risky, maybe even more risky than the startup venture, because you can call your son up and say, how are things going at the LLC? I don't think you can call the people at Bitcoin and say, hey, what's going on there at Bitcoin that the price is varying by 60% overnight? How did that happen? So the reality is there are sources of capital, and they can be used, and sometimes they can be used wisely. In other words, sometimes there's a relatively small amount of money, and you see this occasionally. You'll see a startup that has a great idea, and they don't need that much capital. And providing $5,000 out of a Roth IRA, if that deal gets done appropriately, gets documented appropriately, the paperwork gets done, it gets approved, and let's say it's put into that Roth IRA for 10 years, and it turns out that becomes eBay.
That's a good point.
Now here's
Yeah.
the kicker. That $5,000 might have became $5 million tax-free.
Yeah, that's a good point.
Tax-free. Now,
I don't think a lot of, let's talk about that for a couple of minutes, because we're not CPAs. However, there is something to that. What you're saying is there's other vehicles that people could
Yes.
potentially look at to invest through or
That's
with, right?
That's right. And the kicker
Yeah.
that most people don't realize, sort of the hidden secret that eventually will get fully exposed, is a lot of the wealth among the PayPal billionaires and even among some of the people at big private equity firms were tiny investments made out of Roth IRAs that
Really?
all became tax-free gain.
Wow.
That's the little secret that, you know, if you can put a lottery ticket into some vehicle where the resulting lottery gain, which of course is highly risky, you know, a lot of those lottery tickets don't go anywhere.
Right.
I have a bowl whenever I buy a lottery ticket. After I check the number, I throw the lottery ticket in there because I look at that bowl and say, that's what it means to buy lottery tickets. Literally, you have a lot of opportunities for not making
Yeah,
any money,
that's
right? So you can go to family, friends, or dad or mom or granddad and grandma. Hey, look, you know, people you know, they'll sometimes even tell you, you know, I've got like $5 million in my 401k account, and it's all invested in like municipal bonds. And you say, why is that? Municipal bonds are tax-free to begin with. You can get a better interest rate in any other type of bond. Oh, I really want it to be safe. So they're have the wrong investment actually in that account. So they might say, and there are definitely people who will say, I want an alternative investment with some risk, and I'm looking for startups. And we see this, and I've seen it even in my firm. I've had older people come in and say, you know, if you think there's anything out there that I need to
we
hear
hear
about,
about that every once in a while.
let
Yeah,
me know,
right.
because I have a portion of my 401k. It might be $1 million of the $5 million.
Right.
It might be 100,000 that I'm making little tiny bets with, because I think one of those will be the next Google or the next Facebook or the next Apple, and I want to ride that opportunity. Now, I think in Silicon Valley, this is especially so because there's so many instances where success has happened. So people are more willing to open up their pocketbook. So you can probe your parents, your grandparents, your friends, your family, people that have those assets for, if you move them to a self-managed account, or a self-directed account is actually the formal name. If you're going to search for it on Google, there are a bunch of custodians that will take the money out of Schwab or TD Ameritrade or any of these other players and move it to that account, and then you can get that account to invest in that LLC. And hopefully in the long run, because that's really what most of these investments are, they're 5 to 10 year investments. Some go a lot faster, but most don't. There can be a long-term payout with some tax advantages. So that's the other thing to probe. Now, when you get to the outside real investor, let's call it the typical angel investor, they're going to expect that you're selling what is a class of stock, not common stock, although you'll see some folks say, I just want to sell common stock. I want one class of stock. I don't want to do anything too sophisticated. But most angel investors, certainly most VCs, and definitely super angel groups will say, no, we want preferred stock. Now, this is a class of stock that allows that investor to take priority if the business fails. What we talked about earlier, who gets the residual, they want all the residual because their view is, well, you already have some asset. You already have some customers, and they love that. They love to be able to call the customer up and say, well, you're using, you know, XYZ dog food, and your dogs seem to like it. Why? Oh, you know, it smells so great, and the can opens so well, and they've got the greatest brand. And they want to hear that. They want to do some interviewing to get some verification. And if you're just a startup where there's no one that can provide some verification that what you have is real, they're probably not going to invest. They might politely smile and say, see me in 6 months, because they kind of want to keep the relationship warm because you might be the next Google. But they're not going to go until they know that there's something there.
So
that's why getting those reference customers becomes so important.
So the angels and above are more, the way you're explaining is more for once proof of concept has been done or proved, or as you said, there's actually customers, there's revenue in the door.
That's right.
There's some traction. You're saying, oh, gee, maybe there is something here.
Yeah, years ago, VCs, as I said, used to actually start companies.
Right.
That ship has sailed. That doesn't happen anymore. I mean, there'll probably be a few VCs that'll call me and say, no, you're wrong. We still do it. Okay, fine. Show me your numbers. Okay, 99 we didn't do. We did one. Well, who was that? Well, Elon Musk wanted to shoot a rocket to Mars, so we believe in
Somewhat
him.
risky, yeah.
Right? we wanted to do with him because he was a star. Okay, well, that's such an exception. But in general, VCs are looking, as are super angels, and by super angels I mean like Keiretsu in the East Bay and Band of Angels here in Silicon Valley, and there's dozens of these groups that assemble wealthy people, fully qualified, to do a transaction where they are going to expect some class of preferred stock. Occasionally they'll do a convertible note into preferred stock where they understand, well, we need to raise $5 million, and you guys are only putting in $500,000, so we'll let you get a convertible note pending our raising the other $4.5 million, and they're just batching money together. That happens, but usually only when there's a business that's ready to be scaled. You've already sold $10 million worth of this. You think you can take it to $100 million in the next year if you just had some TV advertising or if you just had some bigger social marketing program.
Right. That's a good point. Is this go along? I'm not sure if this is the right show for it. As you're talking about this, the SAFE agreement and the different agreements and the money and equity for that, people that actually bring in advisory partners, I mean, they may not bring any money at all, but they bring their expertise and they'll say, I'll do X amount of work. So is that tied into this, or is that a little different than what we're talking about today?
No, it's tied in. And it's tied in because usually you want those people to be already in the deal before valuation changes as a result of that preferred stock. Now, let me explain this because it gets complicated. And if we had the interactive screen, we'd put up some graphics. I know in a future show that'll come, right? But in general, the advisors are getting what might be called cheap stock, common stock or options to buy common stock at low valuation. Low valuation, the startup of the business might have a value of as little as $10,000. Right. Little tiny 0.00001 cent per share, which is 1/1,000,000th of a cent per share. Because they don't want to have to spend a lot of money exercising that option, right? They want to just ride the gain. All right. Now, they're already on board. Their resumes are on board. They're giving you advice. They're leading you to investors. They're leading you to VC firms. They're leading you maybe to customers. They might be leading you to distributors, to channels. Now, they're already on board. Now, when the company gets to the point that you're raising a major round of capital, any number north of $5 million would be a major, used to be a major round. People will correct me and say, no, it's more like $50 million. I mean, the numbers have all changed in a market that's gotten so frothy. But years ago, $5 million was considered the typical Series A. People will say today it's probably close to like $25 million. At that point, the business is going to get valued based on what will be the post-money value when that money comes in. So let's do a simple math test. If the post-money value of the business will be $100 million after that $5 million comes in, that preferred stock is going to represent 5% of the equity. Simple math. Yeah. Now, very few VCs, unless it's an amazing company, are going to invest in Series A at that high of a value. More typical Series A, although these numbers have been changing too, is I'll put $5 million in if the post-money value is $15 million, and I want 33%. Why? And the VCs will be up front, or even the super angels. We can't afford to have our talent, which is going to be on your board of directors, spending time unless we have a really big chunk of this company. Right. We can't afford to just have 5% because you're going to raise Series B, Series C, maybe even Series D, and we're going to get diluted with you along the way with all those new raises. So we have to start with a healthy chunk. In fact, I've seen some that come in, and say, we need like 49%. And the founder will say, well, wait a minute, I'm going to lose control of the business almost immediately because there are people out there with options who could decide to
Take
give
us
their
over.
vote to you.
Yeah, right.
So you got to, and this is where our firm is really different than others, and me in particular, because I tend to be in the firm very much is linked to the view that we become philosophically joined at the hip with the founder or the founding team, and we treat money as a commodity. So the negotiation is much more about protecting the team and the founder.
That's a good point.
So that control
Right.
can last long enough to make it worthwhile, so that if you give up control, you get paid for it.
Yeah.
So there are times when someone will say, Joe, I have a lot of respect for you. You're a smart guy.
Yeah.
You've got great ideas. You've founded a number of businesses. But we're going public, and we need someone who's a little older than
Absolutely.
you. Or a little younger than
Well,
you. That's what
or
really
who
gets upset.
Well, that's everybody now. But no, that's a good point, because the other part is someone that's done this before, right?
Exactly.
And you can't blame them.
Well, Steve Jobs was told, hey, we're going to ask you to move over
Yeah.
for the CEO
There's
of
a perfect example.
Pepsi-Cola. And I'm sure at some point said, like, sugared water? Is that what we're talking about? Yeah, that guy knows how to brand a company. We're going to make him CEO because he's going to take us to the races.
Yeah.
And, there was a story there. He eventually kicked Steve Jobs out of the company.
Right.
So, there's lots of interesting stories in Silicon Valley about how this can go wrong. And,
that's
of course,
good.
Jobs came back, which was a major, resurrection.
Incredible story.
It's a great story, but it happens to even great companies.
Yeah, very good. All right, we're going to wrap things up. Good show again today, Jack. So we'll be back next week. I'm not sure what day it is, but we'll be back next week to continue the series. That'll be number 6. Again, for more information, go to reradiolive.com. And if you want more information about Jack's firm, it's computerlaw.com, or you could find that information on our website as well, reradiolive.com. Thanks again for checking in today. Until next time, take care.
Great. Thanks, Joe.
Yeah. That was fun.
Sorry I kept you longer.